Thank you very much, Dean Ball. That was a very great introduction. And I wanted to thank everyone else here for coming today. It's always good to see you at this our little conference, and we seem to be in the middle of the holidays when we do this. And so interestingly, as economists and psychologists and so forth, we all understand how important incentives are. And I recently got a very good lesson about incentives this past Thanksgiving. My family and I, it was going to be my wife and our three lovely children. And, but I'm a very impatient man. And actually, my younger brother has 3 grandchildren already, and I have none. So I felt that it was time to take some action, even though my kids are still pretty young, but between 20 and 26. I announced it right before dinner that I am going to endow a kind of a foundation or whatever of $50,000, which will go to the first kid that has a grandchild. And then I said, now, please let's bow our heads as a note of thanks. And I did that, and I looked up, and all 3 of my children were gone. So that's what's happening there. Okay, so this is about the day, and I think Doug actually covered that. A little bit overview of the Inforum forecast. Things on the domestic front look pretty good. They're about the same as the last year or two. But not so bad, steady. Let's call it steady. Inflation, and I'll talk a little bit about this, is still too low, okay? And this is a vulnerability that we have, especially when you look at the risks. And most of the risks are actually coming from either security, which has been in the news a lot, and it's a true risk, not just to life and limb, but the economy as well. But most of the problem is in other places, especially the economic problems. So we'll talk a little bit about that. And, economists are very bad at predicting when the next recession is coming and even what it will look like. But we're always on the lookout. We're always on the lookout. So I'll throw an idea about that out today. But, usually, just to give you a quick preview, usually recessions follow some action by the Fed. But the economy doesn't work in the old-fashioned way. When we think about, inflation got out of hand, so the Fed had to rise interest rates to squeeze inflation out. If inflation is low, nothing on the site, that's not the story. The story is going to be something different, and I'll talk about that later. Okay, so this is actually out of the 48 conferences, this is the 13th one that I've been a part of and done the outlook. And I was reflecting and putting our slides together that managing the slides and managing the outlook is a lot like managing a softball team, okay, which is something I've done for actually more than 13 years. But what it is, you have these different slides, and the reason why you see the same slides maybe year after year, some of the same slides, is because these are the slides that we think are best to reflect what's going on. Now, some years, some slides kind of fade out. They might come back later. Some, you have old reliables that are there all the time. You've got an order you need to put the slides in. Some slides are fiscal, some slides are monetary. And so I have to shuffle the slides and bring new ones in from time to time, just like when I manage my softball team. But this year, I came out and I said, here's one, a young slide, a couple years old, that this year, actually, I think might be the most promising slide in the deck, okay? So you've heard John Haltwanger at Maryland has done a lot of work that looking at the decline of new businesses. And his most recent paper is about the decline of employment formation at new businesses. And to a large extent, this is pretty alarming because new businesses is where we get most of the net new jobs, as we've talked about in the past. But the other day, we went to the birth and deaths data from the Bureau of Labor Statistics. And I like this indicator for 2 reasons. One, of all the new job formation things, it's easy to figure out and two, it's the one that we have the most recent fix on. Okay, so John's most recent paper had data through 2011. But interestingly, if you look here, in the most, and this goes up, the births go up, I think, through the first quarter of 2015, okay? And you can see that these are actually, they were kind of bumping along in the recovery. They fell in the recession, bumped along to the recovery much later than before, or much lower than before, but now we're seeing a little bit of a revival there. And in net terms, the bursts minus the debts are in green. Now the deaths we don't have out as far, but you can see there's a bit of a surge here. This might be recovery surge. Perhaps this is an early sign that things are changing on this front, okay? I wanted to start optimistic. I don't know if you know Chris Farrell. He's been a marketplace commentator for many years. And back in the 90s, he used to do this show on NPR talking about personal finances. And I met him recently, and I told him that. And I says, you know, when I was real young in the 90s and had my first investment money, planning for retirement, I did everything you said. And he says, oh, that's very nice. And I looked at him, I says, and the one thing you said was I should be investing in TIPS, the inflation-protected securities all these years. And I said, you know what? Those haven't performed very well lately. And he laughed. At any rate, his point is that he's finding in his research is that this group that we've talked a lot about falling out of the participation rate, and that's a lot of the baby boomers, people from 55 to 64 that lost their job and haven't been working, he's finding them to be joining the entrepreneurial class, starting new businesses. Now, it remains to be seen whether this trend pans out, whether it's true that baby boomers come in, start new businesses, and whether those businesses actually hire people, or if it's just basically a one-man show doing consulting or something. But nonetheless, I'm hoping that that's a sign of things to come. So I want to start out optimistic, and so that's our MVP slide for today. The next slide is my usual lead-off, old reliable, just to show you the overview of GDP growth with a history through here, forecast on the lighter side, and our forecast is really more of the same. 2%, a little bit higher than 2% growth. I think our 2016 number is 2.6, 2.7, somewhere along that line. So very similar kind of stuff. It's amazing when you look at the year-on-year how unvolatile this has been. We all know about the first quarters, but in general, growth has been pretty steady. Okay. Still mostly good news on domestic demand. As I mentioned, the expanding employment is going to create positive spillovers, both in housing and just in general consumer confidence. We see the consumer doing pretty well these days, or at least spending money. Oil prices low, interest rates low, consumers confident, all that good stuff. Fiscal side has stabilized, so it's no longer a contractionary force on the economy. Private business, we're still kind of waiting for that bigger surge of investment in equipment, investment in structures. There's a lot of questions on the commercial side of construction. Retail construction doesn't seem to be all that promising given the Amazons of the world. We'll talk about oil as well. And then again, as I mentioned, the biggest vulnerabilities come from abroad. Okay? Pretty strong employment growth. It's been steady as well. It'd be nice to have 280 new jobs a month, at least for a little while. But we're getting about 220, anywhere from 200 to 220. Okay. Is there any slack left? So this is the question. So as the Fed goes into deliberations, the big subject on the table is 5% unemployment close to the so-called NAIRU, or are we going to see wage growth soon? Okay. So we want to look, Janet Yellen addressed this directly last week in a speech, okay? And one of the things she pointed out is, okay, I always hear, you always see, oh, the unemployment rate's down to 5%, and people say, well, that doesn't reflect the part-time, that doesn't reflect the marginally attached and so on and so forth, the discouraged workers. But of course, the U6 actually does, to some extent, pull that in. And so the difference between the U3 and the U6, you can see before the recession, it was 3.8. In the depth of recession, it was 7.2. Okay, so percent unemployed, under labor utilization, peaked at over 16% compared to the unemployment rate at 10, and the peak was 7.2%. Okay, now we're down to 4.9. So not back to the historical average, but a percent above, which is 1.5 million workers that would like to do either would like to work more. Okay, so Janet Yellen mentioned that. So things are getting better all the way around, but that's an indication that slack remains. A second one is the participation rate itself. Okay, so this is the best decomposition that I've seen. We know that the civilian labor force proportion to population has declined mightily, partly because of the recession. But about half of that has been just people getting old and retiring. Okay, so that one was anticipated. We have the cyclical effect in green. So with recession, people lose their jobs, leave the workforce for a while, hopefully come back later. Okay, so that's the green part, the cyclical effects. But we still have about a percentage of that fall in the purple that's not explained by either the residual effects or the aging trends. So that's another 1.5 million workers or so, maybe even a little bit more, that could be coaxed back into the labor force with, they're not really looking at the unemployment rate, they're looking at wages. Okay, so with higher wages, there does seem to be the ability to bring in more labor supply, at least in the short run. Okay, by 2020, 2025, these forces could all be spent, but Janet Yellen, this is her point of saying that we still have slack. Okay, and as I mentioned, wage growth is up, but it's still very small compared to the red one is, typically if nominal GDP grows by 4.5%, that's what you would expect wages to grow by, right? But instead, we've had this depressed wage growth, and it really has not popped up yet. So that's another indicator that there's slack, and it's another indicator that if we start getting the wages up, then we could do something better, okay? So still struggling. The green line is unemployment, so you can see with the fall of the unemployment rate, wage growth has not really revived. Okay, this is why I mentioned about fiscal policy being benign. These are the contributions to growth, to GDP growth that you see in the NIPA table for each one of the big three: federal defense, non-defense, state and local spending on goods and services. And you can see that, normally, back in the last decade, federal defense was leading growth, okay? As the wars wound down, federal defense spending wound down. That's the green one, so you could see that had a depressing effect on the economy. We also cut back starting in 2011 on federal non-defense, okay? It's still at 0. And the big contraction, I think people miss, was the state and local spending, right? So when the recession hit and you have balanced budget laws, you've got to cut back. We anticipate that. And that's exactly why maybe the federal government should step in. But the best thing we see now is that budgets at the state and local level are loosening up, so getting a little better. So it's not leading growth, okay? And maybe you don't want the government to lead growth, but at least it's not subtracting from growth now. Okay, GDP gap, our last sign of slack that I'll show you today, is still not quite there. Okay, and this is the CBO figure. They have a potential growth rate. Did Bob come in yet? Bob Shackleton is the keeper of that number. So we're not quite there. We're about 3% still below. So again, we have room to expand, lots of room to expand. Okay, and the last thing, I guess the second thing I want to say about slack and where the economy is, this is the most relevant graph, I think, still, okay? We are still in a situation where inflation is very low and interest rates are zero. Until next week, we have a little pop, okay? I've already anticipated that the Fed's going to rise by about 1/4 point, okay? But as you see, that's not a heck of a lot in the scheme of things. And the core PCE inflation, the target is 2, and we're still at about 1.3, okay? So no inflation in sight. And there's a lot of economists that feel that we should not be pulling this interest rate trigger until you see the white of inflation's eyes, okay? But I think politically the Fed's been pressured that it's time to normalize. And there's also good economic reasons for getting a normalized monetary policy soon, but we have yet to see. And I'll talk about what may happen if the Fed tightens too quickly. Okay, so this is the most relevant thing. Another thing that's interesting is that everyone's forecast, including one interesting thing to follow is the Fed governors and presidents. They all have their own forecasts. They bring it to the table, and they publish that, not the names, but the points in the FOMC minutes. And you can see the mean forecast of them, and really if you look at blue chip and our forecast and everybody else, is that inflation, and it's the PCE inflation Q4 over Q4, is going to get to 2% by 2017, okay? So everybody says, oh, we'll have normalization, things will look pretty much normal by then. But if you look at inflation expectations, which is a very difficult thing to do. Theoretically, we love inflation expectations because it helps us to determine the real interest rate. But there's 2 sources. One comes from looking at surveys, like the Michigan survey of expected inflation, where they go talk to the man on the street. And the man on the street keeps thinking, oh, well, 3.5%, 4%. So, well, wait a minute. If the real inflation is like 1. Oh, no, it's much higher. So the man on the street overestimates inflation, but what's interesting about those is those numbers have been coming down over time. So the man on the street's beginning to buy into it. The other one, if you think the old story about I want to come back as the bond market, well, the bond market is signaling inflation at almost 0. Almost 0. So they're not any smarter than the guy in the street, okay? Well, the Cleveland Fed has a paper, very complicated, on how they kind of use all the evidence from the market and from the surveys to kind of split the difference, okay? So I don't know whether you buy this or not. It takes a close read of the working paper. But at any rate, they're expected, what they come out between all these is still at 1.5. So they don't, this measure of expected inflation does not see us hitting the target by 2020. So that's very disturbing, actually. That's very disturbing. Again, do we see the white of inflation eyes? No. Okay. And to remind you of why low inflation is so damaging is when the economy, and we've gone through this over the last 6 years, maybe this is being a leaf, but when the economy is especially weak and the interest rate goes to 0, real interest rates are still too high. So the interest rate is nominal is 0, inflation is 1, the real interest rate is -1. And that seems to be too high to eliminate the slack in the economy that I showed you earlier, okay? So that's one problem with it. But with interest rates going up, maybe that becomes less of a problem. Or with unemployment at 5, maybe that's less of a problem. The other problem is when we had this recession, the imperative was for consumers to deleverage, right? Also businesses to deleverage, okay? Well, deleverage is much more difficult. That's when your debt is there, but you're not getting any income growth in the denominator, the debt to income ratio. If the Y's not growing, your debt burden isn't relieved, and it makes deleveraging much more difficult. So if you have a mortgage of $300,000 in your house and your income is flat, that mortgage is a burden. If your income's going up by 3 or 4% a year and that payment is fixed, that debt becomes a lot easier to manage. And that's one thing we haven't had as well. The last one is maybe the biggest one, okay? Because wages and prices are sticky, When you have low inflation, relative prices cannot adjust to clear markets correctly. And so we may have a lot of distortion in the market. So the example I always give people is the following. Suppose you have 10 people that you're supervising, okay? And comes the end of the year, you want to determine raises. You want to reward the people that have done well for you. The people that haven't done so well, maybe you want to give them a cost of living increase. Maybe you want to cut the real wage a little bit to send a message, okay? But if your budget is only going up by 2%, because inflation's only 2%, you don't have much leeway because you can't go to the underperformer and say, we're going to cut your wages. That's intolerable. If you go to somebody and say, hey, you didn't do so great last year, so you're only going to get 0.5%, well, they probably can live with that. But how many supervisors have been able to go to your underperformer and say, well, to give a better bonus, better increase to the high performers, we're going to cut your wage by 1 or 2%. So that relative wage can't adjust. And the same is true not just in labor markets, but in product markets. And that's a big problem with low inflation, okay? The three things that we're wondering. So we need to get inflation up. How do you do, okay, so that's my rant on inflation. Let's talk about monetary policy per se. So as we know, the Federal Reserve has it's not literally printing money, but it's at least figuratively printed money and added all this to the balance sheet. And most of this money is sitting at the Fed as excess reserves of the bank, okay? Well, it turns out that if you want to raise the interest rate, the old-fashioned way won't work, okay? Because if you buy or sell bonds, right? If you sell treasuries to the banks, when all these excess reserves are sitting there, all they're going to do is say, thank you, but it's not going to change the interest rate, okay? Fed's going to have to do something different now, okay? The end of the zero interest rate policy, ZIRP. What's next, okay? Paper by, I probably should have cited it here, but you've seen these things on the internet. This is a paper by Stan Fisher last spring, talked about they have the new tools of the new monetary policy. And the first one is IOER, rate of interest paid on excess reserves. So the Federal Reserve, all those excess reserves we saw, they pay a small interest rate on there. Well, if they raise that interest rate, the banks are going to say, well, we ain't lending out at anything lower than that interest rate. So that puts a floor on the interest rate. That's how you deal with banks, okay? Big problem is half or some proportion of the financial system is no longer banks. It's what we call the shadow banking industry. And they have, on that one, they called the overnight reverse repurchase agreement, okay? Won't go into details, but this is for the Fannie Mae, Freddie Macs, and other types of non-bank intermediaries out there to regulate the interest rate there. So they have some other tools, but these are the two big ones that they're going to rely on to raise that interest rate, okay? The other thing is what happens to all those securities they have on their assets, and they've signaled the fact that they're not going to sell them anytime soon. Now, some of those are going to become mature, okay, and they're going to take the money and run, and they have that schedule actually publicized on how that is, and a lot of it's many years in the future, so they don't have to worry about it so much now. But the real question is what they ever do with these types of things. And I'll tell you now, if we never see inflation rise above 2% again, they're liable to take all those bonds out back and burn them because if you don't want the interest rate to go up, what are you going to do in that case? So there's going to be some interesting things. Let's see how it works. Now, the big thing is, from our perspective right now, is if the interest rate is going to increase in the next year, and rapidly. So this is probably going to be pretty gradual. That's our base forecast. Not going to really disrupt much. But suppose interest rates do go up high, and the rest of the world is loosening. Well, you know what happens is you're going to have a lot of capital coming in to the U.S., stoking our domestic demand, okay, depreciating our dollar, hurting manufacturers, and basically importing deflationary conditions. So I'll talk about that a little bit. I think this is the big vulnerability that we have. Okay, here's our overview. So our overview is pretty conventional. As I've mentioned before to this group, we really calibrate the lift model, which is a lot of underlying structural detail. But at the top line, we want it to look like other people are saying, because mostly we use this model for the what-if scenario modeling. So, but nonetheless, it's helpful to take a look where we are. So 2016, 2.7, so a little higher than what we're expecting this year of 2.5, led by the consumer, okay? Not a over-exuberant consumer, but a confident one. The number here is mostly drilling rigs, okay? So with the plummeting of the oil price, you know, we're just not exploring for oil and gas like we were. So this was, a big dip. But though drilling itself may be pretty flat next year, the rest of this sector, non-residential structures, will recover perhaps quite strongly. Equipment and intangibles, steady. Residential, still strong, okay? We see a lot of momentum in that market. Now here's where the tricky part comes in. So real exports have been very slow this year. We're looking at a little revival, tiny revival, only because Europe is strengthening. China, on the other hand, is decelerating, and that's probably the most, in the best case, it's decelerating. So hopefully, little revival, but not much. It's just these outer years, sorry, these things are too close together. These outer years, which are optimistic, I think, but let's hope. Imports pretty restrained, especially given demand. Government, as we mentioned, more benign, even a little bit of adding growth there at 1%. And, you know, there we are, hopefully at 2% sooner rather than later. 2% or more, okay, sooner rather than later. On the supply side, overall, potential GDP in those outer years at 2.2. You can see the math there. Interest rates slowly normalizing. Okay, unemployment rate stuck at 5. And also, as I've talked about before, our nominal balances between the external balance, current account, and the federal net borrowing, very, very well behaved. Okay. Other forecasts you've seen see the federal net borrowing exploding. I tell people when I see those, I say, well, wait, you know, why don't you just raise taxes? So that's what we do, and it fixes it. Okay. Quick thing on healthcare. As we've also talked about before, the last few years, healthcare expenditures have grown at about the level of GDP, which is the lowest rate on record since 1960. But luckily for Sean and his compatriots and their forecasts, we had a big bump up, well, not a big bump up, but a bump up in 2014. Not surprising, okay, given the Affordable Care Act and a lot of the other factors that were factored into forecasts. So a little bit higher than GDP. Probably we're going to see more of this in the future. You know, it just stands to reason that when people get health insurance, they're actually going to use it, and that means higher expenditures. Okay. The slowdown, this is the decompensation of the what we call the difference between GDP growth and national health expenditures is something called the excess cost of healthcare. And you see this was quite high over history through the whole period, 2.5. Mostly in this period, slowed down in the first decade and very weak from the recession. Okay, and it was kind of split across the board between excess price inflation and excess real expenditure. Okay, so that's the way I like to look at healthcare expenditures. If you're talking about, oh, they're very high, what are you talking about? You're talking prices, you're talking about expenditures. Okay, it doesn't make sense to say healthcare, my healthcare bill is outrunning inflation, because, well, your healthcare bill includes the fact that you're spending more for health care, not just the price. Okay. Mentioned oil, natural gas has been slowing a lot. Okay, the rigs, but this, no surprise. This is, my undergraduate degree was in mineral economics. And mineral economics 101 was, this is the way the mineral investment works. So all my career, no surprise, oil price falls, people in Oklahoma lose jobs, okay? They know that. They're ready for it, hopefully. They weren't ready for it in the early 90s, remember, with the savings and loan crisis, but that's just the way it works. Now, it took a while for production to start falling as well. So production held up early in the year, and the growth now in the last month of this data, which looks like September or so, the production year on year is now level to last year. So that growth is gone a little bit. But yet we still have a lot of capacity. If prices go up and demand goes up, we've got supply to come online. So that's the good news. Okay, that's kind of the baseline forecasts. Risks are big and many. And really the top of the list, at some point, security and economics merge, and I think we may be seeing that here. But consumer confidence, I think, and business confidence as well, is somewhat contingent on the domestic situation settling down a little bit, okay? And I don't know whether that will happen. And then in other countries, in other parts of the world, you have even a lot more vulnerabilities, okay? The other thing now is with interest rates rising, so typically when interest rates rise in the US, emerging markets suffer because the capital that had been going their way and chasing yield now comes back to the US where you can get higher yield much more securely. And so places like Brazil, perhaps Italy, China to some extent, although China has its big stock of reserves and a lot of its domestic savings, not so much. But other Asian countries like Malaysia or Thailand, in fact, I'll talk about this in demand, or in extent. These two things, I've talked a little bit about the third one as well. I'll talk some more. And then the others are kind of the stock ones, unfortunately, that we've used the last few years. Government gridlock, we can't get important things done. Although, I gotta say, recently we've got a 5-year highway bill, okay? So maybe, at least for the moment, there's a little bit of unfreezing there. Perhaps a year from now, there'll be signs of more unfreezing, but we'll see. Okay, secular stagnation, I'll talk a little bit about. And climate change, the thing about climate change is the variability. And so it makes catastrophes like fire in California, big storms that might knock production out for some time. These become more probable, and something bad may happen. And then finally, and I think Melissa Carney will talk more about, the idea that economists are discussing now is, does inequality affect, in this case, mobility, but in other cases, growth in general. So that's an open discussion. Okay. So here we see the foreign situation. We've got reviving economies. Europe is not booming, but it's certainly pulling out of recession. 2013, 2014, 2016 is looking a lot better. Okay, not so great. The China one is, what do you want to predict? We saw Robert Rubin here the other night and said that, well, when people ask what is your prediction for growth in China, the next question is, well, what do you want? Do you want what the government says or what I think it is? And perhaps maybe we're more with the government, but there's deceleration going on there. Russia definitely hitting bottom, crawling back maybe, but a lot of problems there as well. This is what I find more disturbing about, especially Europe, but in other places, is the 2015 rates. Probably should have put these in red because if you see, remember the European Central Bank also targets 2% inflation. and there's nothing like that in sight, even going out 2 years in Europe. Japan, chronic low inflation. Is that a pipe dream of 2.3? Maybe. China, perhaps deflation. US, okay, these are not our forecasts, by the way. These are the OECD. So OECD is a little more pessimistic there. The only folks doing it right, maybe, is Canada, although they're coming out of a quick recession. Mexico, actually doing pretty well. Sorry about that. Okay. This is what I find more disturbing about the global outlook, because the possibility the U.S. can import more low inflation. Okay, the dollar is strengthening. Take that what it is still strengthening. We looked at this last year, sudden change. Maybe the change will be a little less. And manufacturing is already getting hit. So this is the ISM business activity. The blue line is non-manufacturing activity, which is actually, this is one of these diffusion indexes. For anything over 50 means it's expanding. If you're below 50, you're contracting. And for the first time in a while now, hopefully this will be a little bit of a blip like it was in 12, but for manufacturing. But I don't think so. I mean, given the rise of the dollar, given still slow demand overseas, manufacturing could be in a bit of a pickle here. Okay, but hopefully, so in working out our forecast of the exchange rate, we looked at other people's, and people are pretty sanguine about this. Just a little bit more appreciation this year that's already probably baked in the cake, okay? Compared to last year, I mean, the euro lost 20% of its value, maybe another 5% this year. Hopefully, that's it, okay? Hopefully, no more dollar strengthening. It sounds good, and there's no doubt, like the thing about exchange rate movements is the old quip by Harry Truman that I wish I could meet a one-handed economist, right? And I always tell people, I say, like normal people, economists have two hands for good reason. And, this is the thing, as a consumer, knock yourself out. I'd love to have cheaper imports, okay? But as a producer, especially if you're in a tradables business, it's not the best thing, okay? And so you need to get, that happy medium somewhere in between. And spikes like this, which, not only reflect the mismatch of growth between the U.S. and the rest of the world, but it's a vicious circle, and it could be a problem. Okay. So where's the next recession coming from? Well, to go back many, many years, I've lived through several balance of payments crises, and some of them are actually quite close-knit. My first one was in 1981 when I was a Peace Corps volunteer in Ghana, and I had a whole bunch of, at that time, CDs. They would allow us to take 2,400 CDs and convert it to $800 at 3 CDs, the official rate of 3 CDs per dollar. Okay, so I had that stacked away, buried outside, ready to go. So when I left, $800 in 1981 for an itinerant Peace Corps volunteer was a heck of a lot of money. So come May, Ghana had a really acute balance of payments crisis, 81 and 82. And come the couple months before I was supposed to cash out and leave, they brought the IMF in. The first thing the IMF said was to depreciate your currency to 30 to 1. So overnight, literally, I lost $800. And that one stuck with me. The other thing I learned about a balance of payments crisis in 1981, it's an excellent time if you want to lose a lot of weight, because I lost about 45 pounds in that one. Second one, I came to Spain after doing graduate school in the U.S. in macroeconomics. I went to Spain to write my dissertation. And the first thing that really struck me was, and this was 1989, how obsessed they were with this current account problem, okay? How obsessed they were with it. And it was like 2.5 to 3. And I was like, well, in the U.S., that's not a big deal. Spain's a small country, okay? And people say, oh, no, this is going to be a problem. This will end in tears. Oh, no, look, the pesetas appreciating. The whole time I was paid, I originally set up my salary, we converted it into pesetas, and then I watched the peseta climb and actually increased my standard of living quite a bit. So we left in '92, and I left a lot of money over there because I figured it was a nice hedge, and it was sitting in the bank. And then right after I joined working for WIFA, I don't know if you remember this, Alan, the day we had to redo the forecast completely because overnight the European exchange rate system crashed. The peseta depreciated greatly, and again, I lost quite a bit of money in that case, probably about $1,000. And I had to rush and try and get my money out. So that was the second balance of payments crisis that I lived through. Then as an international economist, we remember Mexico. And what is the common theme here is once that current account balance exceeds 5% of GDP, watch out, okay? So Mexico in '94, Thailand led the Asia crisis, if you looked at all these. In Thailand, in Malaysia, Indonesia, the current accounts were all deep. Not the government accounts, but the external account were all 5%, okay? As one great philosopher once said, a yogi, I guess, Deja Vu all over again. Spain, you know, it doesn't matter. Well, you know, the EU system is still very vulnerable. Look at that, at 10%. So who was not, at that time, predicting problems? And in the United States, so I remember in the early 2000s, Catherine Mann, who's now the chief economist at the OECD, I saw her give a presentation where she said, and the US was about here, okay? And she said, anything over 5% of GDP current account deficit is a problem. Watch out for that. And sure enough, and I was telling my classes this at the time, watch out, the US has crossed 5%. Okay? So the other day we said, okay, which countries had the biggest current account deficits leading up to 2008? Iceland, Latvia, Greece, Portugal, Spain, United States, Ireland, okay? Look familiar? Italy is an interesting case because theirs, you couldn't say was particularly high. Who didn't have? Well, Germany had one. Why? Germany's problem was they're the ones that financed all this, right? So their banks were but I think it's kind of obvious what's going on there. Now, right now, this is our forecast. Actually pretty sanguine. But Ron and I are talking about maybe looking at a different case where the interest rate goes up fast, the foreign capital comes in very rapidly, the dollar appreciates, people go hog wild, both buying, you know, cars. I don't know about housing so much, but maybe, and certainly on the corporate side, lots of investment, and we have a couple of years of pretty nice growth, but that current account goes above 5%, and then watch out. Okay. I got left here. So the longer run. Let's talk about the longer run quick. We had this slide last year. So the distinction between secular stagnation and just slow supply growth. Okay, so Robert Gordon's thesis is there's a lot of kind of things going on and sluggish technical change. Don't know whether I buy into that, but certainly his demographics points about the skill level of the U.S. Workers is not really rising. It's been pretty flat for a time now. Our potential growth rate, which we have is 2.2, other people maybe 2.4, other people's at 2.0, he's thinking 1.6, okay? So that makes life a lot more difficult for a lot of reasons, but mostly financing our Social Security and Medicare, okay? Now, Larry Summers and others have talked about secular stagnation, which is a little bit different. It's really a demand-side phenomena, and he's talking about chronic operation below potential output. Summers noticed two things that I just talked about. In the late 90s, we had pretty rapid growth, but it was financed by foreign capital and the dot-com boom. We had a widening of the current account deficit, so you had a bit of a bubble in asset markets. And voila, we had great growth, okay? And then the second crisis was even more so that way, right? So it was, we had sluggish growth coming out of that first recession. Then when the foreign capital started flooding in, especially when the U.S. raised interest rates in 2006 and 7, it stoked our domestic demand, blew bubbles, and all came to tears in the end. So Summer's point is, can we get to full employment? Can we get to potential growth without a bubble, okay? And my point here is, well, let's see. We're going to do that experiment, I think, again over the next 2 years. Okay, let's move. Okay, so quickly to kind of set up Carol's argument a little bit, one of the things we look a lot at is the industry MFP accounts. Doug mentioned the CLEMS account, okay? To be looking at different sources of growth in each industry and then how each industry on the supply side adds to growth. And I will say that Doug and I have looked at this data a lot, and we've scratched our heads a lot, which in my case is kind of dangerous. But one of the things we've noticed through time is that most of the contribution to growth, this was an old, using the old BLS data, this was an old slide of mine, where we saw that 47% from 87 to 2010, 47% of growth is attributable to computer and electronic products. I'm sorry, 38.3 to consumer and electronic products, and then total manufacturing was adding half, okay? It was a real puzzle to us that something could be that much, and it's a lot of it is due to the computer deflator and how they do that and that type of thing. The other thing that we noticed was that healthcare traditionally had negative productivity growth. And so it was, to productivity in general, it was a subtractor. It was a stagnant sector in the Baumol's degrees, that type of thing. But that's the old data. The new data is this integrated BEA, BLS industry level production account. And the most recent paper we took a look at the other day, and they came up with a new conclusion, which is quite interesting. So from 98 to 2013, they said, oh yeah, sure enough, non-information technology industries, this is the contribution, composition, sorry, we should have labeled this, but it's the contribution of industry to growth in the total economy, of MFP. This is MFP growth, okay? MFP growth is gone up by about 0.4 in that time frame. Non-information technologies was a very small contributor. Information technology using industries was also a small one. That goes back to we see computers everywhere, but in the national accounts. Okay, and then the information producing industries, like I showed you on that last slide, contributed, more than half, a little bit more than half of the growth, okay, of MFP, okay? These guys broke now this period up from 98 to 2007, 2009 to 2013, so before and after the recession, and found that this really composition has changed. So now the non-information technology industries are contributing more. The information technology using industries, I'm sorry, this is the old one, so similar to the aggregate. But since then, we've been finding that the non-information technology industries is adding the most to MFP. And the information technology using industries, second most, and the information producing industries, the least. Why? Because, really, we don't have a heck of a lot of them left here, okay? A lot of the things that we now think of high tech, and then Carol's going to talk about this, are services or software, not so much building PCs, okay? So part of that's going on. So just as a preview of what Carol will talk about, but also from the perspective of something to keep an eye on, this is interesting stuff, okay? But the reason why this matters is the following, and we've talked about this before, is that the future ain't what it used to be, and the same great philosopher, Y. Bear, said that. But what we mean by that here is that in the old days, we figured that potential growth was going to go up at a rapid clip, okay? What the recession did for us was, in the short run, really changed the slope, but perhaps even in the longer run. This is what we call hysteresis, right? So we've lost potential growth. And here's the current GDP forecast. So we get back to potential, but nowhere near where we thought we could have been in 2007. Now, maybe that number was wrong, but again, you know, the future just ain't what it used to be. And if you break this down a little bit, in the GDP gaps, you see the difference between hysteresis, which is the, I'm sorry, let's talk about secular stagnation. Secular stagnation is operation below potential. Now, hopefully, as we say, potential degrades a little bit, but we'll get back to there. Hysteresis is actually the degradation of potential because of the shock, okay? So those are two different types of things. Okay, I got about, let's see if we have anything here. These are basically the long-term structural types of things. Here's our current account in total. As I mentioned, we're pretty sanguine right now, but again, I think this is where the vulnerability is. My favorite debt chart about debt held by the public. Debt held by the public plus the trust funds, which is now 104.2% of GDP, 18 trillion as of September. But in the end, of course, the total liability includes pensions of many of you folks in here, Social Security, and then Medicare. So add to the 18 trillion another 50, and you get the true liabilities, but of course all this time, income's coming in, and this is somewhere, according to the trustees, between 6 and 7%. The total debt plus 6% cumulative notional present value. Okay, so basically that does mean that if we honor these promises at all, we're probably going to have to raise taxes somewhere, right? But, you know, now the question is who and how, and that's where tax reform comes in. And you've heard me talk about all these before. You know, the worst tax expenditure out there, and the biggest, is the healthcare premium income exclusion, okay? That needs to be reformed. Now, you don't save all that money if you convert them to vouchers, but you sure make it a little bit more progressive or less regressive the way it is structured now. Mortgage interest deduction, another one that we should phase out. And so once you know, you've heard it, you'll hear it on the campaign trail. Once you take out the so-called loopholes and then flatten the rates, we can have a system that will be less distortionary. And why is that important? Because, as I've shown you, we need to raise more money. We can't just say 18%'s been the historical norm when we've got all these other responsibilities. So there's a lot of good ideas, and I think the most hopeful of them, I will stop there, and we can go ahead with some questions. Oh, and this is to tee up Melissa Carney's presentation, is Does Income Inequality Discourage Growth? And let me go back to this. Since this is also optimistic, I'll stop there. Any questions? And we have microphones, and please identify yourself as well. No questions. Everything was crystal clear, and cool. Yes.
I'm Brian Lincoln with DOL, and I'm just curious, what's the view on secular stagnation in the modeling world these days? Is there, everyone thinks, oh, it's true, and just if you want to expand a little on what's the thinking there.
Okay, I would say for the most part, in the modeling world or in the forecasting world, folks are hoping it doesn't occur. Let's put it that way. Your typical macro neoclassical model is going to say you can't operate with slack. There's too many forces that are going to eliminate that slack, okay? In the real world, I think it's easy to be a little bit skeptical, and I'll tell you why. I mean, the first thing Summers will say when he's trying out this argument is look at expected inflation. Expected inflation is still, as I said, much lower than actual inflation. That means the real interest rate is probably too high to equalize aggregate demand and aggregate supply, and so this can be persistent. You have to shock the economy with something that gets it up there. One is a foreign capital inflow. Perhaps another is, as they've been talking for years, is more fiscal stimulus. But the models themselves say, oh no, we're gonna clear all these markets, and that's not possible to have persistence. But we've had persistence for a long time now. So, yes, Nasser, go ahead.
Thank you for your presentation, Nasser Khilji from the U.S. Treasury Department. I was really interested in looking at your exchange rate assumptions. Interestingly, that everything is going to be depreciating against the dollar. So the question is, how much subtraction from growth, that 15, 16 dollar appreciation you expect, has happened or is going to happen?
So that's a good point. Total growth, it may be a wash because, again, remember, the appreciation implies an inflow of foreign capital, which stokes domestic demand. So that might be a wash. We've actually been working a little bit on this. But when you do look at net exports, and actually, most importantly, exports, okay, so we've got 1.9, and so it knocked it, I'm sorry, this year we went from expecting 2 or 2.5 to 1.2. So I think it's easy to, and everything acts with a lag as well. So the 20% appreciation last year knocked at least a point or more, maybe a little more off of exports, and will do so next year as well, okay? And, so what is that in terms of GDP? Well, that's export side. So on the import side, the other thing is it ends up being a little bit of a wash because as we've talked about before, the pass-through of the rate increase of the dollar into import prices is very muted. And it takes a while, and it's always incomplete. So in that sense, the bigger thing that sucks in the imports, of course, is the domestic demand that I talked about before. So in terms of the total, it may be a wash. In terms of who's producing and who's working, it makes a big difference. So that's what I would say. Now, if you have just appreciation without perceiving the capital flows, you would say, oh, it's going to hit trade a lot. But you got to remember this other point. The real question, I think, is how much interest rates increase and whether that really has any effect on domestic demand. Tom?
Tom Dusterberg. What are your expectations for crude oil prices going forward, and what is the likely impact on capital investment
of that sector?
Yeah.
In particular? So we actually end up using EIA's numbers, which are, if you're an oil man, cautiously optimistic. So a very slow creep in upward in the short run. And I think we do have them in one of the tables. So I think next year we're a little above 50. And right now they're at 37. So if you go to 54, 55, does that sound about right?
So we use the SCEO for the first couple of years,
right.
For 2016, so they do start to creep up. Not terribly quickly, but they do come up. And then we use AEO for longer run.
Yeah, in the longer run, they go by at least the rate of inflation after 2020, say. Probably not in the short run because, so one of the things that we've talked about before is a lot of this investment previously put the holes in the ground, found the gas, and then they said, it's too cheap, we're not going to sell it. So you've got a lot of capacity sitting on the sidelines that it's going to take 2-3 years to work that out if there's an increase. And there will be an increase, I think. But I don't think it's going to get people excited about drilling holes anytime soon.
So I'm Terry Yen from the EIA, but I'm not going to comment on the discussion that happened earlier because I actually have a question about slide 19. I think it's your Outlook overview slide.
Uh-huh.
And I was wondering, I think you mentioned non-residential structures has something to do with oil and gas. I don't remember. I might have misremembered, but I'm just curious if that is the case.
Yes.
Why
So,
there's a huge, why you sort of forecast a huge upward increase for 16 and 17, and then it sort of drops back down?
Well, I think it drops down in the outer years, not
Right,
so
like
much
the 5%,
oil and gas.
But I was curious
Yeah.
about the reasoning behind the dramatic increase in such a short term.
Oh, okay. So here's the idea. So that's a good question. So it's surprising when you go look at the NIPA and you look at non-residential construction. Oil and gas drilling are like 25% of the total. And I was like, oh, that's a lot. So if it falls, if that series has fallen in like it did in 2015 by 50%, I think, that has a big chunk, and that affects that near-term thing. Now, it's now going to be flat. So we don't think it's going to fall another 50%. It might fall a couple, but you're not going to see another big collapse. So that means the rest of the sector, which is manufacturing, healthcare, all the other buildings out there, are going to actually be quite healthy. Then the entire series gets pulled up. Now, by 3 or 4 years down the road, it's going to stabilize out. But that's the reason why you don't see another negative number there. And yes.
Bob Cohen, Economic Strategy Institute. It's interesting that you focused on summers. One of the things that's come up in the last year is the viewpoint of Hal Varian of Google that was in the Wall Street Journal over the summer, that we're failing to measure the impact of the Silicon Valley economy on the larger economy. And he basically argues that we're undercounting the productivity impacts of a lot of the new software that's being developed in Silicon Valley. But one of the things that's happened recently that you didn't highlight is the sizable pop in productivity numbers that we saw. Second quarter 3.3, third quarter 2.2. These are well above the Gordon forecasts. So, I mean, what do you think of this?
Well, two observations don't make a trend. Let me put it that way. So actually, the concern has been about low productivity growth over the last few years, although I'm not so sure I share that in labor productivity. When you have all this excess labor resources and you start absorbing it, it's natural, I think, to see low productivity. But nonetheless, that's been a concern, and it's a concern going forward. Now, measurement is something that we talk about over beers more than in an open forum like this, because this is something we struggle with all the time. And of whether the deflators reflect something that, well, you know, my problem always has kind of been is that we use hedonic deflators unevenly. So some sectors the deflators are plummeting because of the hedonics. Other sectors like healthcare, where, yeah, they've used some hedonics, but even the newest calculations, the healthcare folks still don't buy because they think productivity in healthcare is rising much more rapidly if you would just measure the outcomes right. So when you're putting together a multi-sectoral model that runs over time like ours, which has nominal, real, and prices, this becomes a big deal. And Doug's done a lot of research in that. His presentation at our international conference this year was on precisely that and trying to fit all this together in a uniform framework. So that is a true question. And Carol knows a lot more about it than I, so maybe you can grab her, but it's a difficult aspect of it, and it's another lecture. Go ahead, Pete.
Pete Davis, you talked about the decline in labor force participation, but your kids and my kids aren't forming households, and they're staggering under a lot of student debt. Could you talk about how that fits into the forecast?
Well, this goes back to my first point about offering them money to have children. That's the best way to get them out of the house. Actually, we talked to Larry Young from the National Association of Realtors the other day. We asked him that question specifically about whether the divide between multi-family and one. So multi-family housing has bounced back and is doing quite well. Single-family housing, as you know, has been very, very sluggish, even though it's gradually coming back. And I think this is a very important explanation, is that children today, you know, and how many economic seminars have you gone to the last few years where people didn't note they still had a 20-some-year-old in their basement, okay? And believe me, I'm one of them. So, you know, that's very, very true. And it's not just the debt side, but even it's the lousy wage side. You know, on the other hand, you may have a child that didn't go to college, but can they get a $15 an hour job that might allow them to do something different with their lives? No, they're working at $10, $12 an hour, which with no benefit, well, with minimal benefits, especially in healthcare, but you know, not enough stuff to move out. So wage growth would help that across the board, of course. But and you know, people on the other side too is people want to have children later. There's no doubt about that. And again, I encourage you all to make financial incentives available to kind of change that trend. Okay, I think that's going to have to be all for now. We want to keep things moving along. So thank you very, very much for your attention, and I look forward to talking to you.